everyone, today the Indian mutual fund market is flooded with hundreds of options across various categories, making it very challenging to pick the right mutual fund. So one question I frequently get asked is, Sahil, which is the best mutual fund for SIP in India that would take care of all long-term financial goals? Now I have personally asked many people, what parameter do you look at while shortlisting a mutual fund for long-term financial goal? The most common answer is returns. Naturally, everyone wants to maximize their investment return. Hence, majority of retail investors start SIP based on past performance, often shortlisting funds that have generated highest return over the past 1 to 3 years. But there have been many cases where after 2-3 years, they've realized that their mutual funds are not doing well and they get confused whether to sell, hold or continue the SIP. This is the core challenge with active mutual funds. While some active mutual funds will outperform, there's no guarantee that the ones you invest in will continue to outperform. In fact, a report from SPI VA India for 2023 showed that 73% of active mid-cap and small-cap funds and 52% of large-cap funds failed to beat their benchmark in 2023, even in a bullish market. Another issue with active fund is their cyclical nature. During bull rallies, small and mid-cap funds show significantly higher return as compared to large-cap funds. Obviously, that attracts retail investors towards mid and small-cap, and that's what is happening now. Today, everyone wants to do SIP in mid and small-cap funds. However, it's crucial to balance risk with returns. Mid and small cap funds certainly generate high returns during bull market, but in bear market corrections, they tend to drop sharply. I clearly remember during 2018 to 20, the entire mid and small cap index was down 40 to 50%. Now, I'm not saying mid and small caps are bad, but a balanced portfolio across large, mid and small cap is very important. So there are two important takeaways. First is a lot of active mutual funds fail to beat the benchmark, and there's no guarantee that the mutual fund you start SIP would continue to outperform in the future. And second, while mid and small cap may outperform large cap in bull market, they can also potentially fall sharply during bear market. That's where your index fund comes into picture. Please note that I'm not completely against active funds, but for long-term goals, I recommend that the core portfolio should include index fund. You can still allocate a portion of your portfolio in active funds, but a good portion of your investment should be in index fund. In fact, now that more and more people are realizing the importance of index fund, they are already gaining popularity big time in India. As per recent data of August 24, passive mutual funds have crossed an AUM of 10 lakh crore rupees, although it is still much lower than the active mutual fund AUM, which is around 50 lakh crore. But if you look at the growth rate, 5 years ago, passive mutual funds had an AUM of just 1.77 lakh crore. So within 5 years, this AUM has grown almost 6 times in passive fund. And going forward, passive mutual fund AUM is expected to touch levels of 25 to 30 lakh crore by 2030. That would be 25 to 30% of total mutual fund AUM. Now the question is, how do you select the best index fund for long-term goals? Let's have a look. So first of all, if you look at the advantages of index fund, the biggest advantage is the low cost. Index fund usually have a low expense ratio in the range of 0.1 to 0.2%. compared to active funds with 0.5 to 1.5% range of expense ratio. Now this might look like a small difference, but in the long run, it makes a significant impact on return. Then second benefit of index fund is market link performance. The index funds are actually dynamic in nature as they are linked to the market. If a company underperforms, it is replaced by an outperformer, keeping the index fund aligned with market trend. So if you are optimistic about India's growth, index funds offers a great representation of that growth. Now there are various index funds category like Nifty 50, Nifty Next 50, Nifty 100, Nifty 500 and so on. So Nifty 50 invest in top 50 companies of India. Nifty Next 50 invest in companies ranking from 51 to 100. Likewise, Nifty 500 invest in top 500 companies of India. Here please note that the investment would be done based on the weightage of the company in the index as per the free float market cap. For instance, if Reliance has 8% weightage, so out of 100 rupee, 8 rupee would be invested in Reliance. For most people, a simple Nifty 50 or Nifty 100 fund is sufficient. Just keep in mind that index funds don't perfectly replicate the index due to tracking error, primarily from expense ratio and cash held for redemption. Considering all these factors, Nifty 50 is generally one of the best choice for long-term investment. Now let us quickly look at some of the index fund in Nifty 50 category. So this is the list of top Nifty 50 index fund. You can see the scheme name here, NAV, AUM, rating, 1-year return, 3-year, 5-year return and expense ratio. You have names like Bandhan Nifty 50, you can see the AUM, 1-year return is 22%. So generally, if you look at it, all of them are showing similar 22% kind of return. 3-year return is around 10%, but 5-year return is around 15%, which is a great return for long term. And you can see the expense ratio is 0.1, 0.17. You've got a lot of names like ICICI, HDFC, UTI, Nifty 50, Tata, Nippon, Franklin, Aditya Birla, then Motilal Oswal, Kotak, then Axis Nifty 50, and so on. Now let's quickly look at one index fund and try to understand the constituent within that. So let's click on Axis Nifty 50 index fund and look at the performance. So if you look at 1-year return, it is showing 22%, and current NAV is 14, and you can see this NAV movement as well across time frame of 1 year, 1 month, 5 year. Likewise, if you want to understand more about this index fund, you can see the fund performance as well and the constituent. Here you can see HDFC Bank has got a weightage of 11.3%. Then Reliance has 8.6% weightage. So out of 100 rupee, 11.3 would be invested in HDFC, 8.6 would be invested in Reliance, ICICI is 7.7 rupee, likewise based on the weightage. And then you can see all the top names that include your Infosys, ITC, Bharti Airtel, TCS, L&T, Axis Bank, SBI, Mahindra & Mahindra, and so on. Then you can also see the sectoral breakup. So financial services has got 32.8% weightage. Technology has got 12.7% weightage. Energy has got 11.8% weightage. Consumer cyclical has got 10.8% weightage. Likewise, you have consumer defensive, basic material industries, and so on. Apart from this, you can also see the details for that particular index fund. For instance, here you can see the AUM is 547 crore, cash position. Likewise, you can see your various important parameters like expense ratio of Axis Nifty 50 is quite low at just 0.12%. And you can also look at the fund manager detail, riskometer, and more detail about the fund house, and so on. So in this video, we discussed why index funds are getting more popular in India. And then we looked at Nifty 50 index fund, which is one of the best choice for long-term investment. This wraps up the video. Now tell me in the comment, do you have exposure in index fund or not? And if you find this video informative, please share it with your friends and family to help spread awareness about the benefit of index fund for long-term portfolio. I'll see you next video. Till then, take care.